Hello, welcome back to Financial Management. Our topic this week will focus on dividends. Last week, we went through real options and through financial options. The main idea was that we used flexibility. We wanted to see as a manager, how can we have flexibility and what would we be willing to pay for that flexibility? This week, we're going to focus on payout policy, specifically dividends. We'll study dividend payout in a frictionless environment, meaning an environment where there's no taxes, no information asymmetry, nada. We'll use that to show how the choice of dividend policy is irrelevant to a firm's value. This means that the way that the firm is going to pay out cash to shareholders shouldn't have an effect on firm value. We'll also examine dividend policy as a tool for signaling firm quality. And then in our later topics, we'll look at the way that dividend payouts, such as repurchases, an alternative way of getting cash to shareholders, can also have some of the same effects. So, dividends. Dividends are the portion of corporate profit paid out to stockholders. The dividend is a big factor in the firm's payout policy. So, any cash that's not retained or reinvested into the firm is to be distributed to the firm's investors. That is, the firm's stockholders and bondholders. An example of a payout policy is that the firm could always pay out a dividend equal to 40% of net income and retain the other 60% of net income as retained earnings. Dividends are typically quoted as X many dollars per share. For example, if you own 1 million shares and the company pays out a dividend of 30 cents per share, you get a payout of 300,000, 300K. If there are 10 million shares outstanding, but then the company paid out a total of 3 million in dividends altogether. You own 10% of the firm, therefore you get 10% of the total dividend. So we'll look at dividends being quoted in multiple ways. Any dividend paid out, it's usually going to occur on a fixed schedule. So typically these will be quarterly, and sometimes companies will pay no dividend at all. And this is very common for firms that are in early life and that want to focus on growth, that basically instead of giving cash to shareholders, would rather retain that cash and reinvest it as a way for the company to grow. Dividend dates. There are four important dates regarding dividends. We've got the declaration date. This is when the company declares or announces that it intends to pay a dividend. There's the ex-dividend date, where if you purchase the stock before this day, you will receive the dividend. And if you don't, you won't. There's the record date, the date in which you need to be registered as a shareholder to receive the dividend payment. And this is typically 2 days after the ex-dividend date. And then there's the payment date, the date in which the eligible shareholders actually receive the dividend payment. So we have these four different dividend dates: the declaration date, the ex-dividend date, the record date, and then finally the payment date. There are different types of dividends. Dividends typically take on the form of cash of X dollars per share paid at a regular quarterly interval. However, sometimes dividends can take different forms. Companies all the time can announce a special dividend, which is basically a one-time large dividend. There's also a stock dividend. This involves payment of additional stock, typically of the firm or of a subsidiary of the firm, instead of paying in cash. And then there's a liquidating dividend, where the firm sells off all of its assets and distributes the cash to shareholders after paying off its bondholders. Liquidating dividends are actually taxed at capital gains, not as dividend income. And again, don't worry so much about taxation. That's something that we'll get into later when we look at frictions for this dividend policy. Share repurchases are a different way of paying out a dividend in the form of buying back shares from investors. So typically these will occur on the open market. The firm is going to announce that it intends to repurchase, X percent of shares. Open market repurchases make up about 95% of all share repurchases. So the most common way in which the firm will go and repurchase its shares will be through the open market. There are smaller events that occur that are also economically impactful. So one is a tender offer. And this is the offer to repurchase shares at a pre-specified price for a fixed amount. And then there's a targeted repurchase where you'll go and negotiate with a really large shareholder to figure out the appropriate price to actually go and buy their shares. Before 1982, share repurchases were very rare. Investors would often sue because they thought that the manager was trying to manipulate the stock price or that the manager was using inside information to do something that they, as an outside investor, wouldn't be able to do. After 1982, they became much more common. So the SEC introduced the safe harbor rule, Rule 10b-18, which made it safer for firms to repurchase their shares without fear of being sued. The firm could repurchase their shares so long as there's no huge repurchases in a single day that might leave an impact on the price. So if you buy too many shares in the day and you push the price up, you can get sued for price manipulation. And as long as there are no repurchases on the open or close of the day, when prices are more susceptible to manipulation. And these are two rules that are actively enforced. I've worked on cases in which, again, there have been accusations of a company attempting to manipulate the stock market by purchasing too many shares or not disclosing to investors the frequency with which they would engage in these open market repurchases. Just to kind of show you that these different ways of putting money into the hands of shareholders through dividends and repurchases, they're both very commonly used throughout the market. Okay, dividend policy irrelevance. So what are we saying? A firm's choice of policy for their dividend and share repurchases are irrelevant to the firm's share price. What does that mean? It means how the firm chooses to pay out dividends or chooses to engage in share repurchases does not affect the firm's stock price. Why would payout policy not matter? If we're assuming that there's no market frictions, there's no taxes, and there's no information asymmetry, meaning that managers and shareholders, everyone knows the same set of information. And if we're also assuming that the firm's investment policy is going to be held fixed, canceling a dividend to invest in a positive NPV project would likely boost the share price. So we're not going to think about it in those terms. We're going to assume that no matter what, the firm is still going to engage in the same investment projects. Everything's going to be held constant. The only difference is how the firm's going to pay out cash to shareholders. Is the firm going to pay a dividend? Is the firm going to repurchase some shares? It should have no effect on the firm's stock price. Again, assuming that there's no market frictions. And in the real world, of course, there will be frictions. Dividend policy irrelevance. Consider a firm that pays regular dividends. The managers want to make a special decision about what sort of dividend to issue today. They can pay the usual dividend, raise cash via an equity issuance and pay an even larger dividend, or pay no dividend and repurchase shares instead. And what we'll see is that across all of these different ways of paying out cash to shareholders, the actual price of the firm before the dividend, the cum dividend price, will still be the same. Example one, an all equity firm generates a free cash flow of $5 million per year in perpetuity. The firm has a discount rate of 10%. Assume that there are 1 million shares outstanding. What is the value of this firm, including the current T0 free cash flow of 5 million in this valuation? So the first thing we want to do is value this firm. But what do we know? We know that the firm is going to generate cash flows that pay 5 million per year in perpetuity. So we want to use our perpetuity valuation. We also know that the first cash flow occurs today. So we're going to have two pieces in our valuation. We've got the 5 million today, and then we've got the discounted value, the 5 million divided by 10%, because we know that's how we're going to value a perpetuity to get the present value of all of these cash flows. If we do the math and add it up, what do we find? Well, once you solve for it, you'll find that the value of the firm is going to be 55 million. That's the 5 million for the cash flow today, plus that 5 million divided by 10% to get the present value of the perpetuity, the present value of these cash flows forever. Okay, part B. The firm's current dividend policy is to pay out the entire free cash flow of $5 million every year. That is, they pay a dividend of $5 per share, 5 million divided by the 1 million shares every year. However, the manager is considering different options for the current period, T0. So what is the manager considering? Suppose the manager chooses to pay out the usual 5 million at time T0 as a dividend. What is the price per share before the dividend is paid out? Okay, so first, we know that right now, the firm's value of equity, this is an all equity firm, the value of equity equals 55 million. We solve for that in part A, where we have the $5 million cash flow that occurs at time T0, and then the 5 million perpetuity that occurs every year. We said the discount rate for the firm is 10%. So we added together the 5 million plus the present value of the perpetuity, and we got our 55. Now we also know that there are 1 million shares outstanding. So what is the price per share before the dividend is paid out? We've got our 55 million and we've got 1 million shares. So the value of the firm is going to be $55 per share. The price per share right before the dividend paid out is called the cum dividend price. So this is the price before the dividend. What is the price per share after the dividend is paid out? This is what we'll call the ex-dividend price. Well, let's make sense of this. Okay, the firm is worth 55 million. The firm is going to pay out a dividend that totals 5 million. So the firm's value is going to fall from 55 million to 50 million. And the number of shares outstanding is going to be held the same at 1 million. So the price per share after the dividend is paid out is going to be $50 per share. Okay. Suppose instead that the manager announces that the firm will pay out a $10 million dividend at time T0 as follows. It's going to use its $5 million free cash flow. So that's the 5 million that it has today. It's going to raise another 5 million by issuing equity at the cum dividend price from part B. That is, the firm is currently valued at $55 per share. So they're going to raise another 5 million by issuing equity. And remember, the price is going to be at $55 per share. How many additional shares would the firm have to sell? So the first thing we're going to do in order to solve this part, we're going to ask ourselves, what's the actual number that the firm wants to raise? The firm wants to raise $5 million, okay? So as we solve for this, we're going to say X equals 5 million divided by what? Well, what's the price per share for the firm? The price per share for the firm is 55. So if I have 5 million divided by $55 per share, when I solve for this, I'm going to find that the firm would have to sell 90,909 shares in order to be able to raise the 5 million needed to make this large dividend. Because remember, the firm's going to use the $5 million in free cash flow that it has on hand, plus it's going to raise a bunch of shares and then use that cash together to pay out a $10 million dividend. What is the share price before this $10 million dividend is paid out, but directly after the additional 5 million was raised via an equity issuance? How do we solve for this new share price? Okay, we know that the firm is worth 55 million. Where did that number come from? That was the 5 million in free cash flow plus the present value of the perpetuity, the 5 million divided by 10%. Together, that was 55 million. Now the firm has raised an additional 5 million via this equity issuance. So the value of the firm is now that 55 million plus an additional 5 million. So the firm is valued at 60 million. How do we find the price per share given that we've, increased our number of shares. No longer is our denominator just 1 million. So in our numerator, to find the price per share, we have 60 million. And in our denominator, we have 1 million plus the 9,909 shares that we issue in order to raise that 5 million. So when we do the math, what we'll find is that the price per share is still going to be $55 per share. What is the dividend per share at time t0? So how do we find the dividend per share at time t0? The way that we'll solve this is, again, we'll ask ourselves, how much is the firm actually going to issue in dividends? So our numerator is going to be 10 million. And then our next question is, well, how many shares do we actually have? What's the number of shares outstanding? The number of shares outstanding that we have for the firm, it's actually 1,900,909. So we'll take our 10 million and we'll divide it by the new number of shares. And remember, you have to account for the 1 million shares we had outstanding plus the additional shares that we had to issue in order to raise this 5 million. So what is the dividend per share at time t0? Our dividend per share at time t0, this is after we've issued additional shares to raise 5 million in order to pay for a larger dividend. Our dividend per share at time t0 is going to be $9.17. What is the price per share after the dividend is paid out? So how do we calculate that? Okay, let's do this in 2 steps. First, the firm has 60 million in equity value. That's the $5 million in free cash flow plus the present value of the $5 million perpetuity. When we add those together, we get 55. We just issued a bunch of shares in order to raise another 5 million. So our current equity value is at 60 million. We're going to issue a $10 million dividend. So our firm value, the value of our equity, is going to fall down to 50 million. How many shares outstanding do we have? Well, we've got our 1 million shares plus the additional shares that we issued. So our new equation is going to be the 50 million. That's the value of the equity. But now we're going to divide it by 1,090,909, which is the total number of shares in this scenario. When we solve for this, what we'll find is that the price per share after the dividend is paid out is going to be $45.83. Okay, suppose instead that the manager announces that the firm will pay no dividend at all at time t0. Instead, we'll repurchase $5 million worth of shares. The firm would repurchase shares at the cumulative dividend price from Part B. What is the price per share before the repurchase, and what is the price per share after the repurchase? So let's make sense of this. Suppose instead the manager announces the firm will pay no dividend at all, and instead will repurchase $5 million worth of shares. So if the firm announces that they're not going to pay any dividend, no dividend at all at time t0, and instead will repurchase $5 million worth of shares, we have the firm's equity valued at 55 million. Again, that's the 5 million in free cash flow at time t0 plus the present value of the $5 million perpetuity discounted at 10%. So when we take the present value, we divide our 5 million by our 10%, and we add our other 5 million from our cash on hand. The firm has $55 million worth of equity value. The firm's going to repurchase the shares at the cum dividend price from Part B. So there are 1 million shares outstanding. We know that our price for the firm is $55 per share. And what we want to ask ourselves is, how many shares will the firm need to repurchase in order to repurchase $5 million worth of shares? Well, this is just what we did before. So we're going to have X equal to 5 million. That's the total amount of shares, the value of the shares that the firm wants to repurchase, divided by $55 per share. When we solve that, we're going to find the number that we've seen before, which is 90,909 shares. That's the total number of shares when the firm is valued at $55 per share that the firm would have to repurchase in order to repurchase $5 million worth of shares. Okay, what is the price per share before the repurchase? That's $55 per share. What is the price per share after the repurchase? How do we solve this? The first thing we're going to do is think about our numerator. So our equity value was at 55 million, but now we're going to use 5 million to go repurchase some shares. So the numerator, our equity value, is going to fall from 55 to 50. So now our equity is valued at 50 million, period. Now our denominator, the number of shares that we have for the firm, because we repurchased shares, it's no longer going to be 1 million. It's actually going to be less than 1 million. So 1 million minus the 90,909 shares, it's going to get us at just over 900,000 shares. And when we do the math, what we'll find is that the new value, the price per share after the repurchase, it's still going to be $55 per share. Suppose you own 100,000 shares in this firm, and the firm has chosen the payout policy in Part B. This would provide you with your 100,000 shares multiplied by the $5 per share, so 500K in dividend payments. You were actually hoping that the firm was going to pay out $10 million like in Part C. That is, you were hoping that the firm was going to issue shares, raise 5 million, and then pay out a 10 million dividend. In which case, we said that the price per share, the dividend per share, would have been $9.17. You own 100,000 shares, so you were hoping to receive 917K in dividends. How can you create a homemade dividend of 917K for yourself? Well, the way that we'll think about making your homemade dividend, it's pretty straightforward. You always have the right to sell your shares. So we'll do this in 2 steps. The firm follows the policy that they're going to go to, so you'll only have your 500K in dividends. What you really wanted was your 917K in dividends. So what do? First, we're going to ask ourselves, how many shares would you have to sell to make up for the difference between what you have and what you want? Meaning, we'll take that 917K and subtract 500K. So you have to raise $417,000 by selling off your shares. How are you going to do that? Okay, well, we'll do this in 2 steps. Remember, in this scenario, the firm has issued its dividend. So it issued a $5 million dividend. So the firm's value of equity fell from 55 million at 1 million, from 55 million to now 50 million. The firm's number of shares haven't been affected because the firm didn't repurchase any shares and the firm didn't issue any more shares. So the firm still has 1 million shares outstanding. So the price per share for the firm after this dividend is now 50 per share. That means that the price of the stock that you're holding after you receive this dividend, it's now at $50 per share. So what are we going to do? Okay, we want a total of 917,000. We only have 500,000. The difference between the two, 417,000, we're going to make up by selling our shares. How many shares will we have to sell? We can take the 417K and divide that by the $50 per share to find the number of shares that we need to sell. When we do the math, we'll find that we need to sell 8,340 shares. Okay. So this is how we can create a homemade dividend, meaning we can always sell off some of our shares in order to basically pay ourselves the level that we want. What is the total dollar value of your remaining shares after receiving your 500K dividend and paying yourself the 417,000? So in order to kind of remember, originally we were holding 100,000 shares. Now we've sold off 8,340 shares. So our new value of the new total number of shares that we have has been reduced by slightly over 8,000. So we now only have 91,660 shares. Those 91,660 shares are currently valued at $50 per share. So the value of our shares after receiving our 500K dividend and paying ourselves the homemade dividend of 417K, it's going to be 4,583,000. Suppose that management chose the dividend policy in Part C and thus did not pay you, and thus you did not have to make this homemade dividend. What is the value of your shares after receiving the 917K? So if the firm did the policy that they wanted to follow in Part C, in which the firm raised another 5 million by issuing additional shares, remember, after the dividend payment in Part C, the value of the firm, the value per share, is at $45.83. In this world, I don't have to actually sell any shares because the firm has paid out the dividend that I want. But the value of my 100,000 shares, instead of it being at 55 bucks per share, like it was when the firm did a 5 million dividend, here, because the firm did a 10 million dividend that was issued and they issued additional shares, the value of the firm's price per share is going to be $45.83 per share. So again, as you pause and do the math along with me, what you'll observe is that in both of these scenarios, the value of the shares that you're holding as an investor, the value of the shares that remain in your portfolio will be the same. This is called dividend irrelevance. We considered 3 different dividend policies in parts B, C, and D. We issued the regular dividend. We issued a one-time large dividend, which was partially funded by new equity. And then we had no dividend, but instead we chose a payout policy based on repurchases. Notice that our cum dividend share price, the price before the dividend, in all of these 3 cases was the same. Regardless of the dividend policy that we chose, the price per share remained unaffected by the policy that we picked. So this is called the dividend irrelevance. Dividends and share repurchases, hopefully from this example, it's clear that in a perfect market, after the dividend is paid, the share price is going to drop by the dividend price per share, by the dividend paid per share. A share repurchase does not affect the share price. So in the example that we did, the share repurchase does not affect the share price. The decline in value of the firm from the repurchase, it's perfectly offset by the reduction in shares outstanding. Said differently, though we have a decline in firm value in the numerator, because in the denominator, we're perfectly offsetting the number of shares outstanding by that same amount for the repurchase, everything stays in balance. The cum dividend price does not change with the change in dividend policy. So if a higher dividend is paid now, then it's going to come at the expense of a lower dividend later, and vice versa. All of this, again, is holding the investment policy fixed, and we're assuming that there's absolutely no market frictions. That fact implies that there's no optimal dividend policy in a frictionless market. So this idea was put forward by very famous economists Modigliani and Miller, They introduced this theory of dividend policy irrelevance in 1958. They actually won the Nobel Prize for this in 1985. Dividends in the real world. So in the real world, we can observe sort of very different dividend policies. So if you have time, go ahead and take a look under the key statistics for the dividend policy for Microsoft, and we'll also take a look at the dividend policy for Google. Hopefully, what you'll notice is that there is a frequency of dividend payments. And I hope you notice another pattern. So if you have a chance, go ahead and follow the link. What you'll hopefully observe is that the dividends tend to be sticky, meaning that the dividend prices per share don't really fluctuate that much. Okay, if you have a chance, follow the link and go ahead and look at the dividend for Google. What you'll notice is that Google has never paid a cash dividend. And this is very typical for tech companies, which usually prefer to reinvest the free cash flows in order to continue to grow. Microsoft had a very long time of not paying any cash dividend as well. However, they had a one-time special dividend that was quite famous that we'll look at. In 2003, Microsoft went ahead and allowed the shareholders to get what they wanted, which was a starter dividend and a special dividend. So Microsoft paid a first-time starter dividend of 8 cents per share, and then it surprised everybody by paying a special dividend of $3 per share in 2004 for a total payout of 32 billion US. This is probably the most famous example of a special dividend in history. A few empirical facts. Some firms prefer to pay dividends while others prefer to use share repurchases. What you'll notice, again, if you have a chance to look at the data, is that dividends are much smoother over time than earnings. So the dividend prices tend to be very similar to what they were the quarter before, and we know that earnings can be very volatile. What does this tell us? It tells us that managers are likely reluctant to kind of move around with the dividend. They're reluctant to increase the dividend because if you cut the dividend, that's a really negative signal to the market. So you're going to be reluctant to increase the dividend to a level that you can't sustain because you never want to cut it, and that's a very bad signal to the market. These real-world observations seem to suggest that managers do and should care about dividend policy, which suggests that the dividend policy being irrelevant has more to do with there being frictions in the market. When we have our next lecture, what we'll look at are some of those frictions and how they actually affect dividend policy. But this will conclude our intro into dividends.